Welcome back to the Pro Ticker Podcast. It's Friday morning, and we're diving into those major financial magazine headlines, everyone. Got a whole stack of reports here from MarketWatch, Bloomberg, CNBC, and the Wall Street Journal. Going to unpack it all, trust me.
Yeah, it's a wild ride this week.
So we're talking defense spending, surging tech giants, global trade tensions, even a glimpse into what Warren Buffett might be thinking. Buckle up, get ready. It's a deep dive into what really matters in the markets and what it all means for you this week.
Yeah, and I think it's interesting how it all seems to be interconnected too, like these stories, right? They're all feeding into each other in fascinating ways.
Absolutely.
So let's start with this MarketWatch piece on defense stocks. Seems Defense Secretary Pete Hegseth is considering some potential spending cuts, a hefty $50 billion to be precise.
Okay, $50 billion. That's a huge number. But you know what I noticed? MarketWatch is also saying analysts are still predicting high growth for certain defense companies. So how do we reconcile those two seemingly opposing ideas?
Well, I think it comes down to understanding the nuances, right, of where those cuts might fall and where the investments are being prioritized. So think of it as like a strategic realignment rather than just a simple reduction.
Okay, so almost like they're doubling down in certain areas and cutting others.
Right, exactly. MarketWatch highlights a screen of 10 defense companies that are expected to see the highest revenue growth through 2026. And some of these names, I gotta say, are quite intriguing.
Yeah, well, let's dive in. What stood out to you?
Well, at the top of the list, we have Rocket Lab USA. They specialize in space systems, and they're projected to see an astounding 5.5% growth.
Wow. I mean, I guess that kind of highlights, the increasing significance of space and defense strategies.
Yeah, absolutely. It's not just science fiction anymore.
Right, exactly.
What other companies are on that list? Well, another interesting one is AeroVironment. They're known for their unmanned aircraft systems, or drones, as we more commonly call them these days.
Right.
They're projected to see a solid 16.1% growth.
Okay, so still really strong.
Yeah, very healthy. And even Boeing, the industry giant, is expected to experience a healthy 21.3% growth, despite those potential cuts.
So it seems like even amidst the uncertainty, there are pockets of opportunity, right? For those who know where to look, this is what separates those, savvy investors from the rest, isn't it? They can see beyond the headlines and understand those, underlying trends.
Absolutely. It's not just about reacting to the news. It's about anticipating what's next.
Exactly. And CNBC even reported on a European defense-focused ETF that has attracted $1 billion in assets.
Right, and that's a clear signal of where that global investor interest is heading. There's a growing recognition that defense, especially companies focusing on cutting-edge technologies, they have that long-term growth potential.
Okay, so let's shift gears a bit. Let's head over to Asia. Bloomberg is reporting some exciting news about Alibaba. Their shares are surging, up a whopping 15% in Hong Kong, trading after exceeding sales estimates. And it seems like they're not alone. This is part of a broader rally in Chinese tech stocks.
Yeah, the Hang Seng Tech Index, which tracks those major Chinese tech companies, hit a 3-year high.
3-year high, that's impressive. What's fueling this surge?
Well, Bloomberg points to two key factors. First, we have DeepSeek. It's a homegrown Chinese AI startup that's making significant breakthroughs in, well, artificial intelligence. This has investors buzzing about the potential for Chinese tech companies to capitalize on that AI boom.
Right, AI is definitely the hot topic these days. It seems like China is not going to be left behind. What's the second factor?
Well, it appears that President Xi Jinping has been meeting with tech leaders, signaling a potential shift in Beijing's stance toward the tech sector.
Interesting.
It seems they might be easing up on those tight regulations that have been holding companies back, maybe fostering a more innovation-friendly environment.
So less government intervention, more room for tech companies to flourish. Now, this is where things get really thought-provoking. UBS strategists are reporting that Chinese tech stocks, including giants like Baidu, Alibaba, Tencent, and Xiaomi, they're currently trading at a 34% discount compared to the magnificent 7 tech giants we have here in the U.S.
That's a significant discount. And it raises some important questions. Is this a buying opportunity? Or are there underlying risks that explain this gap?
Yeah.
Are we witnessing the emergence of a new tech powerhouse that could challenge the dominance of Silicon Valley?
And how will this impact the future of technological innovation on a global scale? A lot to consider there. But before we get too caught up in the future, let's bring it back to the U.S., see what's happening in our own backyard.
Sounds good. So MarketWatch has been reporting on a slowdown in the S&P 500 after 2 years of, pretty robust gains.
Yeah, it seems like those gains couldn't last forever, right? What's causing this slowdown?
Well, Walmart's recent earnings guidance has shaken some investor confidence. They're projecting lower sales growth, which has triggered concerns about the health of the U.S. consumer. And this concern is reflected in the Dow experiencing its biggest one-day drop since January.
Okay, so that's a pretty significant drop. Are we on the verge of a downturn?
Well, Not necessarily. Strategists at Ned Davis Research suggest this might just be a consolidation phase before we see more robust gains. It's like the market's taking a pause, catching its breath before the next leg up.
So a pause rather than a full-blown retreat. But amidst this slowdown, there's one area that seems to be defying the trend: tech stocks.
That's right. MarketWatch points out that tech stocks have seemingly decoupled from their difficult relationship with bond yields. Remember how they were moving in sync for a
I
while?
do, yeah.
Well, that pattern seems to have broken down, suggesting that stock prices might be returning to a more fundamental-driven approach.
So we're moving away from the influence of interest rates and back to a focus on a company's actual performance.
Precisely. And speaking of performance, let's take a look at what the Oracle of Omaha himself is doing, Warren Buffett.
Ah, yes, Warren Buffett. Always a fascinating figure to watch. What's he up to?
Well, according to the Wall Street Journal, his company, Berkshire Hathaway, is sitting on a record $300 billion in cash.
$300 billion. That's an incredible amount of cash. What's he planning to do with it all?
Well, that's the million-dollar question. Some speculate he's waiting for the perfect opportunity. A truly undervalued asset that aligns with his investment philosophy. Others see it as a sign of pessimism, a bearish outlook on the current market.
So is he a patient genius waiting for the perfect moment to strike? Or has he missed the boat? What could we learn from his approach, from his patience, in today's fast-paced market? It's intriguing how his actions, or in this case inaction, can send ripples through the entire financial world.
It certainly underscores the importance of having a clear investment strategy and the discipline to stick to it. Even when the market is tempting you to chase the latest trends, sometimes the best move is to wait for the right opportunity, even if it means sitting on a pile of cash.
Yeah, it's a valuable lesson, that's for sure. Now, speaking of uncertainty and potential market shifts, let's broaden our perspective a little bit. Look at the global economic landscape. CNBC has been covering President Trump's latest moves on the trade front, and it seems things are getting a bit tense.
Yeah, I've been following that story as well. Trump has proposed new tariffs, right, on a range of goods, including autos, chips, and pharmaceuticals. This has sparked some concerns, obviously, about a potential trade war, which, could have some significant implications for investors worldwide.
Absolutely. If these tariffs are implemented, we could see higher prices for consumers, disruptions in global supply chains, even retaliatory measures from other countries. It's a really complex situation. Has the potential to create a ripple effect across that global economy. Yeah, it's a bit of a powder keg, isn't it? And to add another layer of intrigue to this global trade saga, Bloomberg has been reporting on something called the Mar-a-Lago Accord.
Right, this is where things get really interesting. This accord, while it's still just a rumor at this point, is being discussed on Wall Street as a potential plan to revamp that entire global trading system.
Okay, I'm all ears. What's the gist of this accord?
Well, the details are still a bit murky, but it supposedly involves weakening the U.S. dollar and encouraging, or perhaps even pressuring, foreign creditors to swap their U.S. treasuries into ultra-long-term bonds.
Okay, so weakening the dollar and pushing for long-term bonds. What's the underlying strategy here?
Well, the apparent goal is to reduce the U.S. debt burden, while simultaneously bolstering American industries. By weakening the dollar, U.S. exports become more competitive on that global market. And by locking in foreign creditors with long-term bonds, the U.S. could potentially reduce its short-term borrowing costs.
Okay, so it's a strategic play to kind of reshape that global financial landscape, potentially to the advantage of the U.S. economy. But wouldn't this have significant repercussions for other countries and the global financial system as a whole?
Indeed. The potential ramifications of this accord are far-reaching and complex. It could lead to currency fluctuations, shifts in global trade patterns, even geopolitical tensions.
This brings up an important question for our listeners. How might these global shifts, whether it's the proposed tariffs or this rumored Mar-a-Lago Accord, impact your investments? Is it time to diversify your portfolio? Maybe seeking opportunities in markets that are less affected by these potential upheavals? Or is it better to hunker down and ride out the storm?
Those are crucial questions. Each investor needs to consider carefully based on their individual circumstances, risk tolerance, and long-term investment goals. It's a time to be informed, strategic, and perhaps a bit more cautious than usual.
Yeah, for sure. Now, before we wrap up, let's zoom in on some specific earnings reports that caught our eye. CNBC covered Rivian, the electric vehicle maker. They managed to beat earnings expectations, but they're forecasting lower sales in 2025.
It seems they're facing some headwinds, perhaps related to the broader economic slowdown or increasing competition in the EV market.
Yeah, it's a tough market out there. Renault, the French automaker, on the other hand, reported record operating profit and exceeded revenue expectations.
That's encouraging news for the European auto industry. It seems they're successfully navigating the transition to electric vehicles, finding ways to thrive in a changing market.
That's good to hear. And lastly, Airbus reported that their profits took a hit despite raising their delivery target.
Yeah, it appears they're still grappling with those persistent supply chain challenges that have been plaguing the commercial aircraft sector for some time now.
Yeah, those supply chain issues just won't go away. But what's interesting is how these individual company stories, whether it's Rivian's challenges, Renault's success, or Airbus's struggles, they actually reflect those broader trends we've been discussing today.
You're absolutely right. The rise of AI, those global trade tensions, the ongoing evolution of the electric vehicle market, these are all powerful forces shaping the business landscape, impacting individual companies and that global economy as a whole. It's a reminder that staying informed about these macro trends is essential for understanding the performance of individual companies and making informed investment decisions.
Well, we've covered a lot of ground today, from defense stocks and Chinese tech giants to Warren Buffett's cash pile and the potential for a global trade shakeup. It's enough to make your head spin.
It certainly highlights the dynamic and often unpredictable nature of the markets, but that's also what makes it so captivating, wouldn't you say? There's always something new to learn, a new development to analyze, and some new opportunity or challenge to navigate.
Absolutely. Before we wrap up, let's distill some key takeaways from this whirlwind of information.
Okay, sure. I think the first takeaway is that even amidst the uncertainty and potential headwinds, opportunities for growth still exist. We saw that with those defense companies poised for growth despite those potential spending cuts. It's a reminder that savvy investors are always looking for those hidden gems, those companies positioned to thrive even when the broader market is facing challenges.
Yeah, that's a valuable reminder. Opportunity often arises in those unexpected places, especially for those who are willing to look beyond the surface. What other key insights stood out to you?
Well, the rise of Chinese tech is undoubtedly something to watch closely. Alibaba's surge, the overall rally in that Hang Seng Tech Index, DeepSeek's AI breakthroughs could all point to a potential shift in the global tech landscape. And this raises some key questions for investors. Is this the moment to invest in Chinese tech companies, or has the ship already sailed? And how will this rise impact the global competition for technological innovation?
Yeah, it's a fascinating development with the potential to, reshape the future of technology. It makes you wonder if we're witnessing the birth of a new tech powerhouse that could challenge that dominance of Silicon Valley. Okay, one last takeaway. What can we glean from Warren Buffett's massive cash hoard?
Well, I think it reinforces the importance of patience and discipline in investing. It's not always about chasing the latest hot stock or trying to time the market perfectly. Sometimes the best approach is to wait for the right opportunity, even if it means, being patient and letting those opportunities come to you.
Wise words for the Oracle of Omaha, indeed. Okay, any final thoughts for our listeners? Something to leave them pondering as they head into their weekend.
Well, given what we've learned about defense spending cuts, the focus on innovation in the sector, and the rise of Chinese tech with their own AI breakthroughs, what sector do you think offers the most compelling investment opportunity to us right now? Defense or tech? Or perhaps something else entirely?
That is a tough one. It's a question that requires, careful consideration and a deep understanding of your own investment goals and risk tolerance. But it's a question worth pondering. Thanks for that thought-provoking question. And thanks to all of you for tuning in this morning for our deep dive into the latest market moves. We'll see you all tomorrow morning with new headlines from major financial magazines.
It's a question that could spark some lively debates over the weekend, that's for sure. And speaking of debates, I think one of the most compelling insights from our deep dive today is the potential for disruption and uncertainty, really on a global scale, whether it's those proposed tariffs, the rumored Mar-a-Lago Accord, or the rise of Chinese tech. We're seeing these forces at play that could significantly reshape that global economic and technological landscape.
It's a reminder that, we're living in a truly interconnected world where events in one corner of the globe can have ripple effects that impact us all. And it kind of highlights the importance of staying informed, being adaptable, and maybe even, reconsidering our investment strategies in light of these potential shifts.
Absolutely. It's a time to be both discerning and opportunistic, to carefully assess the risks and rewards, and be prepared for those unexpected twists and turns.
For sure. Now, before we let our listeners go, let's zoom in on a couple of financial instruments that were mentioned earlier and might not be familiar to everyone. Firstly, we talked about Alibaba's convertible bonds, which, according to Bloomberg, are performing exceptionally well this year. Could you explain what convertible bonds are and why their performance is significant in this context?
Certainly. So convertible bonds are essentially debt securities that give the holder the option to convert them into a predetermined number of shares of the issuing company's stock. So they offer a bit of a hybrid approach, combining that fixed income aspect of a bond with the potential for capital appreciation if that underlying stock performs well.
So they offer a bit of, downside protection with that upside potential of stocks.
Exactly. And in Alibaba's case, the strong performance of their convertible bonds suggests a high level of invested confidence in the company's future prospects, despite those broader uncertainties surrounding the Chinese tech sector.
It's another indicator of, the complex dynamics at play in the markets right now. Now, you also mentioned an ETF that caught your eye. It was a European defense-focused ETF that CNBC reported had attracted $1 billion in assets. Can you elaborate on what an ETF is and why this particular one is noteworthy?
Sure. So an ETF, or exchange-traded fund, is essentially a basket of securities that trades on an exchange, similar to a stock. ETFs offer investors a way to diversify their portfolios and gain exposure to specific sectors or asset classes without having to buy, individual stocks or bonds.
So it's like a one-stop shop for a particular investment theme or strategy.
Precisely. And in the case of this European defense-focused ETF, the influx of $1 billion in assets, it suggests a growing appetite among investors for those defense-related companies, particularly those in Europe. This aligns with our earlier discussion about, the potential for growth in the defense sector, despite those potential spending cuts in the U.S.
It seems like investors are seeing opportunities in this sector on a global scale. Okay, any final words of wisdom for our listeners before we wrap up today's deep dive?
I think the overarching message today is to, embrace the complexity and uncertainty of the markets. Don't shy away from it. Instead, equip yourself with knowledge, stay informed, and be prepared to adapt your investment strategies as that landscape evolves. And remember, amidst the volatility and the headlines, there are always opportunities for those who are willing to look for them.
Well said. Thanks for joining me today for this deep dive into the latest market moves. It's been an insightful and thought-provoking discussion.
The pleasure was all mine.
And to all our listeners, thanks for tuning in. We'll see you all tomorrow morning with new headlines from major financial magazines.